All right, let's dive into Warren Buffett's 2017 letter to Berkshire Hathaway shareholders.
Ah, yeah, Buffett's letters. Always a treat.
They're packed with insights, aren't they?
Yeah.
It's like getting a peek behind the curtain.
You really get to see how he thinks, how he approaches investing.
So for 2017, Berkshire's net worth jumped by, get this, $65.3 billion.
That's huge. A 23% increase in per share book value.
But there's a little asterisk there.
Yeah, about 29 billion of that gain came from changes in the U.S. tax code.
So it wasn't all from, Berkshire's actual business performance.
Exactly. And that's why Buffett puts so much emphasis on operating earnings.
Operating earnings. So what are those in a nutshell?
It's basically the money a company makes from its core business operations.
Not just like one-time gains or paper profits.
Right. It's about the real earning power of the business.
So in Buffett's world, these operating earnings are the real measure of success.
It's like looking under the hood to see how the engine is actually running.
Makes sense. Now, Berkshire has a few ways of building value.
Acquisitions, internal growth of existing businesses, and of course, investments.
But 2017 wasn't exactly a banner year for acquisitions, was it?
No, not really. Buffett actually had some pretty strong words about the market in his letter.
He was not happy with the prices he was seeing.
He called them an all-time high and even compared CEOs eager to do acquisitions to, well, teenagers with raging hormones.
That's a pretty vivid image.
It shows you how frustrated he was with all the irrational exuberance in the market.
So if everyone's throwing money around, how does Berkshire stay disciplined?
Their secret weapon is their aversion to leverage.
They'd rather sit on cash than overpay or take on too much risk.
You got it. It might mean missing out on some deals in the short term.
But it also means they can sleep well at night.
Exactly. No sleepless nights for Buffett and Munger.
Speaking of acquisitions, they did manage to snag a piece of Pilot Flying J in 2017.
Yeah, a 38.6% stake in America's largest travel center operator.
It was a sensible purchase, especially compared to some of those crazy deals out there.
And he even gives a little shout out to Pilot Flying J in the letter.
He encourages people to stop by if they're on the interstate, mentions the food and showers.
It's those little touches that make these letters so fun to read.
It's like even with billions of dollars, he still sees the human side of business.
It's about real businesses serving real people.
Okay, let's shift gears now and talk about Berkshire's insurance operations.
Ah, yes, the powerhouse behind Berkshire's success.
This is where we get into the whole float thing, right?
Exactly. Float is essentially free money that Berkshire can use to invest.
But I'll be honest, I'm still a bit fuzzy on how it works.
Think of it like this. You pay your car insurance premium 6 months in advance.
Right.
That money sits with the insurance company, and they get to invest it until they need to pay out claims.
So they're making money on your money, basically.
That's the idea. It's a huge advantage for Berkshire.
And in 2017, their float was what, like $114.5 billion?
That's right, a massive pool of capital to work with.
But of course, insurance comes with its own set of risks.
Right. Oh, absolutely. Hurricanes, earthquakes, you name it.
Which brings to mind Buffett's analogy about insurance loss reserves being like a self-graded exam.
He's basically saying that you need to be honest with yourself about potential losses.
Even if those losses haven't happened yet.
Yeah, it's about being realistic and prudent in your risk assessment.
So you can't just like give yourself an A+ on a test just because you want to.
Exactly. You need to be honest and acknowledge the potential for things to go wrong.
Especially when you're dealing with something as unpredictable as hurricanes.
But from what I understand, Buffett isn't too worried about those.
He sees them as a manageable risk, given Berkshire's financial strength.
Remember, we're talking about a company with over $100 billion in cash.
It's like they have a giant safety net.
Well, more like a giant fortress.
Okay, so apart from this insurance behemoth,
Berkshire also owns a ton of non-insurance businesses, right?
they do. It's a pretty diverse portfolio.
Railroads, utilities, manufacturing companies, retailers.
It's almost like a snapshot of the American economy.
You could say that.
It's amazing how they manage such a wide range of businesses,
And Buffett's focus is on increasing earnings from this group.
which is where his appetite for large acquisitions comes in, right?
He knows that organic growth can only take you so far.
So he's always on the lookout for those elephant-sized deals.
The ones that can really move the needle for Berkshire.
And with over $116 billion in cash reserves, they certainly have the ammo.
They're like a giant battleship just waiting to fire.
Okay, we can't talk about Berkshire without mentioning their stock portfolio.
Their investments are legendary.
What's so unique about their approach?
They don't see stocks as just ticker symbols. They see them as ownership in businesses.
So it's about being a partner in those businesses.
Exactly, participating in their long-term growth.
And speaking of long-term thinking, I'm dying to hear about the bet.
Oh, yeah, that's a good word.
The one where he challenged the entire hedge fund industry,
He put his money where his mouth is.
pitted a simple S&P 500 index fund against a bunch of fancy hedge funds.
And, well, the results were pretty surprising, to say the least. We'll get into all the juicy details after a quick break.
We'll be right back. All right, so the bet, Buffett versus the hedge funds.
Yeah, $1 million wager on the future of the market.
What happened? Who came out on top?
Well, Buffett put his money on a simple S&P 500 index fund.
That's his style. Keep it simple.
Exactly. Low cost, diversified, just track the market.
And he went up against a portfolio of hedge funds.
These are the big boys. High fees, complex strategies.
So what happened? Did those hedge funds blow the index fund out of the water?
Not even close. The index fund delivered a total return of 85.4%.
Wow, that's pretty good.
The hedge funds, on the other hand, averaged just 22%.
Ouch. Not a great look for the hedge fund industry.
It was a pretty resounding victory for passive investing.
A big win for the little guy, you could say.
It shows that you don't need to be a Wall Street wizard to beat the market.
Just stick with the basics, keep your costs low.
And be patient, that's key.
But there's more to this story, right? They didn't just buy the index fund and sit back for 10 years.
You're right, there's a bit of a twist. Initially, they funded the bet with U.S. Treasury bonds.
Those are supposed to be super safe.
But then interest rates tanked, and those bonds turned into a terrible investment.
It's like sometimes the safest investments can actually be the riskiest.
Especially when inflation is a factor.
So what did they do? They didn't just throw in the towel, did they?
Not at all. In a move that surprised even Buffett, they decided to sell the bonds.
Bold move.
And they used the proceeds to buy, get this, Berkshire Hathaway stock.
Whoa, talk about putting your money where your mouth is.
This shows their confidence in Berkshire's ability to grow its value.
And they did a little kindergarten-like analysis, as Buffett calls it.
They figured Berkshire would grow its value by at least 8% annually.
Even in a mediocre economy.
Which blew those bond yields out of the water.
So it wasn't just about winning a bet. It was about making a smart investment.
It highlights the importance of understanding intrinsic value.
Not just following the crowd or chasing hot tips.
It's about looking for long-term value.
This whole bet story is fascinating.
It really is, and it offers so many lessons for investors.
But beyond the bet itself, the 2017 letter also gives us a peek into how Buffett and Munger make decisions.
They're like the dynamic duo of investing.
So what's their secret sauce? Do they spend hours debating every move?
Actually, Buffett says they've never had a disagreement.
Really? That's hard to believe.
But they also don't spend a lot of time formally consulting with each other.
So how do they do it? It's like a mind meld or something.
They share a similar philosophy, a long-term outlook.
They've been working together for so long, they just get each other.
Buffett says, we just don't trade pieces of paper. We buy businesses, and we don't buy very many.
Yeah, it's a pretty simple approach when you think about it.
Focus on the fundamentals, find good businesses, and hold them for the long haul.
But that doesn't mean they're sitting on their hands.
They're always looking for opportunities, but they're very selective.
They'd rather sleep well than chase after every deal that comes along.
They're not afraid to walk away if the price isn't right.
It's about discipline and patience. Those are the key ingredients.
It's not about being the smartest person in the room. It's about making rational decisions.
The 2017 letter also dropped a bit of a bombshell about succession planning.
Yes. The announcement of Ajit Jain and Greg Abel as vice chairman.
It was a clear sign that Buffett was starting to think about the future.
He was putting the pieces in place for a smooth transition.
And he had some high praise for Jain and Abel, calling them world-leading performers.
He clearly trusts them to carry on his legacy.
It shows that he's not just thinking about the next quarter or the next year.
He's thinking about the long-term health of Berkshire.
He's building an institution that can thrive for generations to come.
And that brings us to the practical lessons from this letter.
What can we, the everyday investors, learn from all this?
Well, the importance of long-term thinking, for one.
Don't get caught up in the daily noise of the market.
Think like an owner. Focus on the fundamentals.
And be patient. Let your investments grow over time.
Do your homework. Understand the businesses you're investing in.
And don't be afraid to be different. Think for yourself.
It's not about following the crowd. It's about making smart decisions based on your own research.
And remember, you don't have to be a financial genius to succeed.
Even a simple index fund can be a powerful tool for building wealth.
It's about discipline, patience, and a long-term perspective.
So, as we wrap up our deep dive into this fascinating letter,
what would be a Buffett-like investment today?
That's a great question, something for all of us to ponder.
What companies or industries embody those principles of value and durability?
It's a challenge, but that's what makes investing so interesting.
Thanks for joining us. We'll see you next time. Okay, so we've talked about operating earnings, the power of float, and that epic bet with the hedge funds.
We've covered a lot of ground, that's for sure.
But I'm wondering, what does it all mean for the average investor? Like, what are the practical takeaways?
Well, I think one of the biggest lessons from this letter is the importance of long-term thinking.
Long-term thinking, yeah, that's easier said than done, though, isn't it?
It definitely takes discipline, no doubt about it.
Especially when you see the market going up and down every day, it's tempting to react.
It is, but Buffett has this great analogy. He compares investing to planting a tree.
Planting a tree.
Yeah, you don't plant a tree and expect it to grow into a giant oak overnight, right?
No, of course not. It takes time. You got to nurture it.
Exactly, and just as you wouldn't rip up that tree every time the weather changed.
You shouldn't panic and sell your stocks just because the market dips.
You got it. It's about having a long-term perspective.
So how can we, train ourselves to think more like long-term investors?
I think it starts with shifting your mindset about stocks.
Okay, how so?
Don't think of them as just ticker symbols or pieces of paper. Think of them as ownership in businesses.
Like we talked about earlier, right? Be a partner in those businesses.
Exactly. Focus on the fundamentals, the long-term prospects.
Not just trying to time the market or make a quick buck.
You're in it for the long haul.
So it's about understanding what makes a business tick.
It's about doing your homework, studying the financial reports, the industry trends.
Like a detective looking for clues.
You don't have to be a financial expert, but you should strive to understand what you're investing in.
I get it, but this can all sound a bit daunting, especially for someone just starting out.
Sure, it can seem overwhelming, but remember the bet.
The S&P 500 index fund versus the hedge funds.
Right, and the index fund won, proving that simplicity can often be the best approach.
Keep it simple, stupid, as they say.
And Buffett himself recommends index funds for his own family.
So even if you're not a seasoned stock picker, you can still invest like Buffett.
Index funds give you instant diversification, low fees, and a way to ride the broad market.
It's a great way to get started.
And then as you learn more, you can start exploring individual stocks or other investment strategies.
So regardless of your approach, the key is to be patient, be disciplined, and focus on the long term.
Don't chase hot tips. Don't get caught up in speculative bubbles.
Do your research, make decisions based on sound principles, not emotions.
And don't be afraid to be different.
Like Buffett, he's always marched to the beat of his own drum.
He ignores the crowd, sticks to his principles.
And that independent thinking, combined with his knowledge and patience, has made him one of the greatest investors ever.
It's inspiring, really.
So as we wrap up our deep dive into this incredible letter,
I want to leave you with one final thought.
okay, hit us with that.
Given everything we've discussed, what would be a Buffett-like investment today?
That's a great question.
What companies or industries embody those qualities of enduring value, strong management, and a competitive advantage?
It's something for all of us to think about.
It's a challenge, but that's what makes investing so fascinating.
Thanks for joining us on this deep dive into Warren Buffett's wisdom. We'll see you next time.